Silver isn't rallying anymore. Silver is repricing, and the paper market is starting to lose control of the story. You can hear it in the way the commentary changed overnight. Yesterday, it was speculative froth. Today, it's safe haven. And tomorrow, it'll be healthy consolidation right after the move already happened. That's not analysis. That's damage control. Because the price is loud, sure, but the bigger tell is what's happening behind the price. The cost to carry risk the urgency in the nearby market, and the way leverage is getting squeezed out like air from a sealed room. And if you stick with me, I'm going to give you something concrete, not vibes, 2 key zones that matter. What has to break for this thesis to fail, and the checklist for the next 1 to 2 weeks that tells you whether this move is just a spike, or the opening act of a 2026 dominant story that most people will only understand after it asks already expensive. And here's the conflict nobody wants to say out loud. There are entire corners of the financial system that benefit from silver being treated like a sideshow. When silver is just a volatile metal, it stays small in people's minds. And small markets are easier to manage, easier to hedge, easier to dismiss. But when silver becomes a macro asset again, when it becomes a trust trade and an industrial bottleneck at the same time, then the rules change. Because silver doesn't just trade on belief, it trades on delivery windows, refinery capacity, and the ugly reality that you can print contracts faster than you can mine, refine, and ship metal. And that's where the real pressure starts. Look at the speed of what just happened. Early January, silver was living in the low 70s per ounce. Then it started climbing. Then it started sprinting. And within weeks, it was tagging the 90s, at points pushing into the mid-90s. That matters not because number go up, but because velocity is a diagnostic tool. Slow moves are negotiations. Fast moves are forced behavior. Fast moves are stops getting hit, margins rising, hedges chasing, and somebody on the wrong side realizing that the exit door isn't as wide as they thought. And when you see silver do that, when you see it make a series of sharp steps higher instead of a gentle incline, it's telling you that this market is being moved by mechanics, not headlines. But that's not even the part that matters. The hidden detail, the one that reframes the whole setup, is that silver S-battle isn't just spot price versus sentiment. It's the cost of controlling exposure when volatility explodes and financing becomes a weapon. In plain English, when a leveraged trader is short, or when a dealer has written options, or when a fund is running a carry trade, they aren't just betting on direction. They're betting on stability. They're betting on being able to roll positions, meet margin, and fund inventory without getting suffocated. And in 2026, the suffocation risk is the story. Because when silver rips higher, the collateral math doesn't politely adjust. It jumps, and that jump forces behavior. The next detail is what flips the whole setup. Futures markets are built to net risk and clear trades efficiently, but the trade-off is brutal. You have to post performance bond margin to keep your position. The higher the volatility, the more margin you need. The faster the price moves, the more likely you are to get a margin call at the worst possible time. And that is how I am right long term becomes I am dead this week. That's not conspiracy, that's plumbing. When you hear people talk about paper manipulation with a cartoon villain voice, it turns serious viewers off, and it should. But if you want the real institutional story, you don't need a villain. You just need incentives and constraints. Banks and dealers want orderly markets because they are paid to intermediate risk, not to get caught holding it. Funds want liquidity because their investors demand daily pricing and the ability to exit. Industrial buyers want certainty because they have production schedules and contractual deliveries. And when silver starts moving like this, all 3 groups get stressed, but in different ways. And that's where you can see who is being forced to do what. Because if this one level breaks, the math changes. Before we even talk about collapse, let's define what that word actually means in a finance realistic way. Most collapses don't look like a movie scene with people screaming on a trading floor. A modern financial collapse is confidence cracking. It's the slow realization that the old hedges don't hedge, the old correlations don't hold, and the cost of protection becomes so high that everyone starts competing for the same lifeboats. That's when weird assets turn serious. That's when the small markets, like silver, become dominant not because they're the biggest, but because they're the most sensitive to stress. Silver is a pressure gauge. When the system is calm, it can be ignored. When the system is tense, it becomes a spotlight. But that spotlight blinds people too, because silver is also the metal that whipsaws hard enough to punish both greed and fear. And that's why you need a plan before you need an opinion. Now, why now? Why is this happening into 2026 instead of being just another metals pop? The calendar is the catalyst, and most people treat it like trivia. Earlier positioning matters because funds rebalance, risk committees reset limits, and a new performance year begins. When a market has been trending and then accelerates into January, you get a nasty feedback loop. Managers who under-owned the move feel career risk managers. Who overown the move feel blow-off risk, and both groups react to the same price bars with opposite emotions. At the same time, you have delivery windows and option expiries marching toward you like deadlines. Liquidity can thin on specific days, spreads can widen when market makers pull back, and the easy hedge becomes expensive. So you get these moments where price doesn't drift, it snaps. And that snap is what you're watching right now. But here's the twist. This move isn't emotion, it's math. Let me show you the math without turning this into a textbook. Imagine you're short a silver futures contract, and silver jumps $10 in a session. On a standard 5,000 ounce contract, that's $50,000 of mark-to-market loss. That's not theoretical, that's your account equity getting hit now. If you're releveraged, and most of the big positioning in commodity futures is at least partially leveraged, your broker doesn't show up and down and ask how you feel. They ask for cash, same day. And if you don't have it, you don't get a motivational speech. You get liquidation. That liquidation is buying pressure into a rising market. That's short covering, and it can become a spiral. The price rise triggers margin calls. Margin calls trigger forced buying triggers more price rise, and the cycle repeats until either new sellers appear with real balance sheet capacity or the market exhausts itself. And that's the difference between a normal rally and a squeeze-like move. But silver adds a second engine, options, reflexivity. When call options get bought aggressively, market makers who sold those calls hedge by buying futures or spot exposure. That's delta hedging. If the market is in a spot where dealers are short gamma, meaning their hedging needs increase as the market goes up, then rising price forces them to buy more. Not because they're bullish, but because their risk model demands it. This is the part retail investors almost never connect to silver, because they associate gamma squeezes with single-name stocks. But the mechanism doesn't care what the asset is. If options positioning is skewed and the move is fast enough, the hedge becomes fuel, and that's where the real pressure starts. Now stack on the third engine, physical versus paper tension. Silver is traded in enormous paper volumes relative to physical. That's normal for most commodities. But silver is unique because it's not just an investment metal. It's also an input. It gets consumed, and consumption changes the character of supply. If I buy oil futures and oil goes up, there are massive flexible supply responses in logistics and storage. If I buy silver futures and silver goes up, supply response is slower because a big portion of silver production is byproduct, tied to mining decisions for other metals, and refining capacity is a bottleneck. You can just snap your fingers and produce deliverable bars in the exact form the market wants. And if demand shifts toward physical at the same time that paper leverage is being squeezed, you get a market that starts trading like it's running out of time. That's why spreads matter. That's why term structure matters. That's why the price can look insane and still be rational under stress. Everyone's watching the headline, but the signal is somewhere else. Look at the term structure conceptually. In a calm world, longer dated futures can trade above spot because there's a cost to carry, the financing and storage cost. That's contango. It's basically the market saying, time costs money, but when the market gets urgent, the nearby contract can trade rich versus later contracts. That's backwardation. That's the market saying, certainty is worth more than time. For a precious metal, persistent backwardation isn't supposed to be common because these are storable assets. When it appears, it's a stress flare. It doesn't automatically mean there's no silver, but it does mean the marginal buyer values immediacy, and the marginal seller demands a premium to give it up. And that's the kind of behavior you see when physical supply chains are tight, when financing is stressed, or when there's a scramble for deliverable inventory. But that's not the part that matters yet. Inventories are the next layer. And this is where people get fooled. You'll see someone post, warehouse stocks are huge, and declare the shortage narrative dead. That's lazy. In metals, inventory has categories. There is metal that meets specifications and sits in approved warehouses, and there is metal that is actually registered and available for delivery against futures contracts. Those are not the same thing. Eligible can become registered, yes, but only if the owner is willing. In a stress environment, owners become unwilling. That's not illegal. That's rational. If you think the metal will be more valuable tomorrow, or you think the cost of replacing it will rise, you don't volunteer it into the delivery pool. So the deliverable supply can tighten even when total inventory looks okay, and when deliverable supply tightens, the nearby market starts to act weird. Spreads widen, roll costs change, and paper comfort fades. And that's where the real pressure starts. Now take it global, because silver is not a single exchange story. London matters, not because it's romantic, but because it's a settlement hub. The London Vault system is part of the plumbing for the over-the-counter bullion market. When vault holdings shift, or when there's chatter about tightness, or when lease rates spike, it's telling you that the system is paying up to access metal now. LBMA publishes vault data, and at the end of December 2025, London vaults held on the order of tens of thousands of tons of silver, about 27,818 tons. That number sounds enormous, and it is, but here's the trick. What matters is not the size of the pool, it's the marginal availability and the direction of flows. If metal starts getting pulled into one region, say a surge in US stockpiling or a wave of ETF demand, then the pool can look stable while the free float inside it gets tighter. It's like a stadium. The head count might be the same, but if everyone crowds into one narrow corridor, movement becomes impossible. That's why a market can feel fine right up until it doesn't, and that's why people get blindsided, because they were staring at totals instead of watching the bottlenecks. But here's the next detail that flips the setup. Institutional flows. ETFs are often described like passive vehicles, as if they don't change the physical market. In calm times, maybe. In stress times, they become demand shock machines. When a silver trust takes in large inflows, authorized participants have to source silver to create new shares. Even if it's not one-to-one in every single moment, the general mechanism pulls metal into investment channels. And in early 2026, reporting and market commentary has pointed to very large retail-driven inflows into silver-linked funds, hundreds of millions of dollars in short bursts. That's not just interest, that's pressure, because it competes with industrial demand. And industrial demand doesn't negotiate with your chart. Industrial buyers don't say, I'll wait for a pullback. They say, I need supply for manufacturing. Silver sits inside solar electronics, certain high-performance applications, and the broad electrification narrative. That means he has a baseline bid that doesn't T-vanish just because the price got scary. It can soften, sure, but it doesn't disappear overnight. And that's why silver can dominate in 2026. It is one of the few assets that can be simultaneously a monetary barometer and a supply chain choke point. Now zoom back out to macro, because financial collapse is ultimately a macro story. You don't need the world to end for trust to shift. All you need is a regime where the cost of money, the stability of currencies, and the predictability of policy become questionable at the same time. When trade tensions flare, tariff threats, retaliatory moves, geopolitical posturing, you get two things: risk-off demand and supply chain uncertainty. The market starts pricing in disruption, and disruption makes inventories more valuable. It makes having it now more valuable. It makes hedging more expensive. That's why metals surge during trade fear cycles. That's why gold and silver can move together, but silver often overshoots, because it's thinner, more volatile, and more reflexive. And that's where you see the institutional behavior change. When silver starts acting like this, it forces risk managers to reduce exposure, not because they think the narrative is wrong, but because volatility is a tax. Volatility increases margin. It increases VAR. It increases capital usage. That means some players must sell or reduce, not as a view, but as a constraint. And that can create violent pullbacks even inside a bull regime. This is the part viewers must tattoo on their brain. A thesis can be right and still hurt you. A trend can be real and still whip around like a live wire. If you're waiting for smooth confirmation, you don't understand silver. Silver confirms by trying to throw you off. It will spike, then dump, then grind, then spike again. It will gap on a Sunday open when liquidity is thin, then fill that gap just to mess with people's emotions. And the people who get trapped are the ones who confuse adrenaline with conviction. So let's build the psychology shield right now, because if you don't do it now, the market will do it to you later. The market's favorite manipulation tool isn't illegal activity, it's your nervous system. It uses volatility to create urgency. It uses headlines to attach emotion to random candles. It uses round numbers to lure you into impulsive decisions. Your job is to separate trend signal from noise. Trend signal is structure, higher highs and higher lows with persistent demand, dips being bought faster, spreads staying tight in the nearby, and institutional vehicles absorbing supply. Noise is the intraday chaos, the fake breakdowns, the wick hunts, the it's over tweets after a single red day. And here's a simple rule. If your decision changes because of one candle, you didn't have a plan, you had a mood, but that's not the part that matters. The actionable part is the roadmap. Let's talk levels and scenarios without pretending we can predict tomorrow's exact print. Right now, silver is living in a zone where psychology is just as important as valuation. The obvious magnet is $100. Round numbers in commodities aren't magical, but they are behavioral. They cluster orders. They cluster media coverage. They cluster option strikes. That means they cluster hedging flows. So as price approaches $100, you should expect two opposing forces: profit taking from those sitting on big gains, and forced buying from those who can't afford to be short into a psychological breakout. That collision is what creates the fast, then violent behavior. So what are the two scenarios for the next 1 to 2 weeks? Scenario 1 is the controlled pullback and retest. In this path, silver backs off from the highs, bleeds down into a prior breakout zone, think the low 90s or high 80s area, depending on how the next few sessions print, and then stabilizes. Stabilization isn't a green day. Stabilization is dips getting bought without panic, spreads not blowing out, and the market refusing to stay below a key zone for long. If this happens, it's bullish because it resets leverage. It shakes out weak hands. It gives new buyers an entry point without requiring a vertical chase, and it sets up a cleaner move later. Scenario 2 is the continuation squeeze. In this path, silver doesn't give you the pullback you want. It consolidates shallow, maybe 2 or 3 tight sessions, then rips again, possibly gapping in thin liquidity, straight into and through 100. That is the move that makes people feel like they missing a once-in-a-decade event. It's also the move that carries gap risk, because if it's being driven by forced buying, it can reverse hard the moment the forced buying exhausts. That's not bearish, that's just how squeezes behave. The key is not to fall in love with one scenario. The key is to watch what confirms each. In scenario 1, the confirmation is a higher low and a quick reclaim, after dips with no structural breakdown. In scenario 2, the confirmation is shallow dips, aggressive bid support, and the market punching through resistance levels like they're wet paper. And what invalidates the bullish dominant story? Not a red day, not even a sharp dump. Invalidation is structural, a breakdown below a major prior support zone that doesn't reclaim, combined with the stress signals easing, spreads normalizing, urgency fading, ETF flows reversing, physical premiums cooling. If those things happen together, it means the market is depressurizing, and that would tell you this was an overshoot rather than a regime shift. But if the price pulls back and those stress signals stay firm, that's the tell. That's the hidden detail coming back to the surface. Because if the market is still paying up for immediacy, still absorbing supply, still showing reflexive behavior, then dips become opportunities for the dominant side. And that's where the real pressure starts. Now let's talk about why silver can dominate 2026 specifically, not just January. Dominance doesn't mean it goes up every week. Dominance means it becomes the asset everyone has to reference, the way oil dominates when inflation is about energy, the way the dollar dominates when liquidity is about funding. Silver dominates when the conversation is about trust plus supply chain. In a year where trade tensions and policy unpredictability remain high, where debt narratives keep getting louder, where central bank signaling and currency confidence can wobble, metals become more than a trade. They become insurance. And silver is the insurance that also has a consumption engine. That is why the upside can be explosive. Investment demand shows up in a market that was never built to comfortably absorb it while also feeding industry. And because silver is smaller than gold, incremental flows matter more. $1 billion into gold is a ripple. $1 billion into silver can be a wave. But that wave doesn't come politely. It comes with turbulence. And turbulence is exactly how the market shakes out the people who don't belong. That's why you are seeing narratives swing wildly. The same people who mocked silver at $70 are suddenly explaining why it had to go to 90, and if it goes to 110, they'll tell you it was obvious. That's not foresight. That's narrative chasing. Your advantage as a retail investor isn't speed, it's clarity. You can choose not to play the game of emotional reaction. You can choose to watch the mechanics instead. So here is the checklist, the what to watch next, that turns this from entertainment into a framework. First, watch the behavior around round numbers. $95, $100, and any sharp reaction zones that form in the next few sessions. Not because the numbers are magical, but because they show you where the order book lives. Second, watch how fast dips get bought. If every dip is met with immediate bids, that's strength. If dips start hanging and bouncing weakly, that's fatigue. Third, watch term structure behavior and nearby tightness cues. You don't need to be a spreads trader to notice when the market starts paying up for immediacy, when the front of the curve feels hot. Fourth, watch institutional absorption. Flows into major vehicles, and the broader risk-off tone in markets. Fifth, watch the macro catalyst calendar. Policy events, tariff deadlines, major speeches, and especially the moments when liquidity is thin, weekend opens, month-end rebalancing, and option expiry windows. Because those are the moments when price discovery gets distorted and forced behavior dominates. And sixth, watch your own behavior. That's the one nobody puts on a chart. If you feel the urge to do something because you're anxious, that's not a signal, that's your limbic system. The market loves to harvest that, and that's where the real pressure starts. Now, about financial collapse. If your brain hears that and imagines a single day where everything breaks, you're going to misread this. Collapse, in the investable sense, is a slow burn that creates sudden spikes. It's confidence eroding until it snaps at the edges. It's the cost of hedging rising until normal portfolios start behaving abnormally. It's the realization that paper promises are only as good as the plumbing that supports settlement, financing, and liquidity. In that environment, silver doesn't need a fairy tale shortage to become dominant. It just needs repeated episodes of stress where the market learns, again and again, that silver is not a comfortable asset to be short, and not an easy asset to source when everybody wants it at once. And if that learning continues through 2026, dominance becomes a self-fulfilling loop. Higher prices attract flows, flows tighten float, tighter float increases volatility, volatility forces risk managers to react, and reactions amplify moves. That's reflexivity. It's not mystical, it's just feedback. But let's be honest, there are counterpoints, and you should respect them. Margin hikes and tighter risk rules can cool a move by forcing speculators out. A sudden easing of geopolitical fears can pull the rug on safe haven demand. A sharp rally can temporarily choke industrial demand if buyers delay purchases or redesign components. A stronger dollar or a surprise shift in rate expectations can change the macro tailwind. And if silver runs too far too fast, it can create the mother of all mean reversion moves. None of that is bearish long term. It's just reality. Silver punishes certainty. So the right posture is not all-in euphoria. The right posture is conditional confidence. You respect the trend, you respect the mechanics, and you respect the invalidation points. You don't marry a price target, you track the structure. Because if this one level breaks, the math changes. So what are the concrete takeaways? 1. The move we're seeing is being driven by mechanics, margin, hedging, and physical urgency, not just sentiment. 2. The hidden detail is the cost and constraints of maintaining exposure in a high volatility environment. When that cost rises, forced behavior becomes the buyer. 3. The calendar matters because liquidity and positioning resets can turn normal price action into gaps and squeezes. 4. The proof stack isn't one thing. It's the velocity of price, the behavior around term structure and nearby urgency, the reality of deliverable versus total inventory, the global plumbing signals in vault flows and leasing tightness narratives, and the observable institutional retail absorption through silver investment vehicles and physical market strain. 5. The next 1 to 2 weeks are about 2 scenarios, controlled retest versus continuation squeeze, and your job is to watch confirmations, not to force predictions. And 6. Your edge is psychological discipline, because silver will try to make you do the exact wrong thing at the exact wrong time. If you can hold that line, if you can be the person who watches mechanics instead of noise, you're not just investing. You're operating like a risk manager. And that identity shift is everything. Here's a subtle truth. The market doesn't reward the loudest conviction. It rewards the best process. It rewards the people who can say, this is my base case, this is my squeeze case, this is what invalidates me, and this is how I size risk so I don't get emotionally liquidated. That's the difference between catching a move and becoming a statistic inside it. And if you've made it this far, you're already in the minority, because most people click off the moment the conversation becomes about plumbing. That's why I'll say it plainly, the crowd will keep chasing headlines, but silver is trading a structural story. And 2026 is shaping up to be the year that story stops being optional to understand. Near term, keep $100 as the psychological collision zone. Keep the low 90s or high 80s region as does the dip get defended? Test. And keep an eye on whether any sell-off looks like profit-taking or like a structural break. If it's profit-taking, you'll see fast stabilizations and aggressive dip buying. If it's structural, you'll see slow bounces and failed reclaims. That's the tell. And if you want a community that cares about the tell, not the hype, then you already know what to do. Stay with the mechanics crowd. Stay with the people who ask, what forces participants to do what? Because that's how you survive silver. And that is how you are positioned to benefit if silver really does dominate the market in 2026. Not as a meme, not as a myth, but as the asset where the system's stress shows up first, loudest, and hardest to ignore.